Hello and welcome to the Empowering Law Firm Leaders podcast, where we sit down with experts across the legal sector to discover the mindset, behaviours, skills and digital tools that are needed to run a successful modern law firm. I'm Amy Bruce, host and marketing director at Osprey Approach. And today I'm joined by Yorkshire's 2019 Accountant of the Year winner, legal financial expert with over 20 years in the sector, originally training at PricewaterhouseCoopers, and now owner of Sursum Advisory, who provide law firms with strategic financial consultation and fractional CFO services. Tom Blanford, welcome to the podcast, Tom. Thank you so much for joining me.
Thank you, Amy. Good to be here.
So today we'll be discussing how to build a financially resilient law firm. We'll cover essential characteristics of a financially successful firm and the steps to build long-term resilience. We'll also comment on the findings and insights from the Law Society's financial benchmarking report, covering strategies for growth and improving cash flow. So thank you, Tom, for joining me today. We'll be diving into the findings from the benchmarking report soon. But first, tell us a little bit about yourself and your background that's led you to where you are today.
So chartered accountant by training, please don't hold it against me. But despite being an accountant, sort of the vast majority of my career has been spent in and around law firms. So you mentioned a second ago that I did my training contract at PwC. That's quite true, but that was in their professional practices team. So even as a trainee, I was working with the ginormous international firms, the DLAs, the Adelshaws of this world. That's completely true, Amy, but I was a trainee. So I made the tea and did the photocopying in the offices of DLA Piper and Adelshaws and things like that. And then, yeah, sort of a variety of roles since then. Perhaps most notably, I was a partner at Armstrong Watson, who, as you may know, they were the Law Society's only endorsed accountancy firm. So in a team there, only talking to you if you're a law firm dealing with hundreds and hundreds and hundreds of law firms. And then, as you say, more recently, in the last 3 or so years, set up by myself with just a couple of members of staff. But whether that was, PwC 20 years ago, Armstrong Watson today, all of it is strategic finance projects for law firms. It's just over time I've gone from the very big ones to the medium ones to now the small ones. But I have to say, the smaller law firms are much more interesting. So I'm glad I've sort of worked my way down that food chain.
So I'd love to jump into some quick takeaways. Hopefully people can stay till the end, but if they can't, can you share 3 top essential characteristics of a financially successful law firm?
My 3 top tips. So I think my first tip is to understand some of the data and the financials within your firm. And I think in saying that, some people, maybe they run a P&L off their system or something like that. And that's not an awful place to start, but I would query whether that's quite what you need, whether that really helps you understand what's going on in your business. So my first tip is to have a couple of numbers, and you will know better than I for your firm which numbers those are. Have a couple of numbers that are relevant to you and track those numbers over the space of 2, 3, 4 months, and you will spot a trend, and that number will be heading down or up or left or right, or something will be going on. And then understand what you can do about it and change it. I think the reason I make this point is, rightly or wrongly, many lawyers are not numerate people, and that's fine. And frankly, it's the reason I've got a gig. So long may it continue. But what that sometimes creates is a scenario where partners and managing partners just are spooked by all of it. There's too much numbers and there's too many reports and I just don't understand it. Well, that's fine. Just pick 1 or 2 numbers. Let's just focus on those and build from there. So that would be my sort of overarching main point. The second thing that I would probably speak to people about is something called lockup, which I know I'm using jargon straight away, but lockup is the idea that at any given moment you have an amount of work in progress, that is to say, an amount of time that I've put on the clock and that I've not yet built. So that's work in progress. You also have an amount of invoices that you've sent out the door, but that have not yet turned into cash. So those are often known as debtors, right? So if I add my work in progress to my debtors, those two numbers combined are lockup. And lockup is a number that is used throughout professional services, law firms, accountancy firms, architecture firms. And it's probably one of the most important metrics, because what it really means is how much time have I got either in my system to be billed or on a bill that's out there in the ether. How much of my time has not turned into cash yet? And so knowing what that number is and why that number is what it is and what you can do about that number and how that number has changed is really, really, really important for firms. And I'm going to try and avoid getting on my high horse too much, Amy, but kind of different firms are better or worse at it. Different departments are better or worse at it. And understanding the sort of ebb and the flow of that means that ultimately what we're talking about here is cash. And knowing how your cash flows through your business and how that works is incredibly, incredibly important. Let me give you two examples. If I ran a clinical negligence firm, I would expect my lockup to be years and years and years. Because that first bit, the putting time on the clock bit, your average clinical negligence matter is measured in months and months and months and months before I can send an invoice out the door. Months and months and months and months. So I need to know that, right? I need to know that I've started this one today, but I'm not going to be paid on it for, again, years. But maybe there's another one that I started 2 years ago, and so I'm due to be paid on it now. And as long as that's true, and I've sort of got a knit one, pearl one going on in my life, then maybe I'm okay, but I do need to know that. Let me give you the opposite extreme. If I run a conveyancing department, I might assume that my average conveyance is some small number of weeks, right? 8, 9, 10 weeks, something like that. So if I'm running a report and there's something on there that says that it's been building up WIP in the system for the last 15 weeks or 20 weeks, well, that's massively out of kilter, isn't it? So what's gone wrong? What is it that's causing the blockage on that file? And at which point it started as a financial conversation, but it's no longer a financial conversation. Now it's an operational one. Right? That my average conveyance takes 8 weeks, but this file's been sat on the system for 20 weeks. What's gone wrong? What's the problem? How do I unlock that? What is the issue there? Does that fee earner perhaps need some help with something? So that's my second tip, lock up. Partly because it's just important to know your personal ebbs and flows, but mainly because it actually becomes an operational number, not a financial number. And then thirdly and finally, I guess I couldn't, get away with not doing something sort of quasi-regulatory. So I'm going to remind everybody about the solicitors' accounts rules and the fact that they're a thing. And in a world where the SOA is already talking about tightening up various things about client accounting, and we'll see where that consultation lands. I suspect you and I might even talk about it a bit later, but the consultation has closed. I'm sure the SOA is thinking very hard about what they're going to do, but I'm also sure they're going to do something. So my third and final thing is make sure your client accounts are relatively clean. Are they reconciled? Are you sat on loads of residual balances? What is going on there? And it is a little too easy to sort of forget about it, and you move on to the next thing. And that £3 office copy, oh yeah, I will get round to sending that to charity. But have you and actually get round to it. I suspect whatever comes out the consultation, we will see some tightening of some rules. So perhaps getting yourself to a cleaner place, getting ahead of that a little bit would not be a stupid thing to do.
Yeah, no, great top 3 tips. So we've got know your data, pick 1 or 2 things that really matter to you that you can track. understand your lockup, get that cleared out, get that understood so that you could look to improve efficiencies in your operations or understand if anybody needs help or training. And third, be aware of the SRA account rules and make sure you're sticking to them, keep as clean as possible. Who knows what's going to happen out of this consultation? So the better place you're in now, the better place you're going to be able to adapt to that. Just going back to the data and the stats in your first point, is there anything in particular that you see really successful or really resiliently, like financial resilient firms track? Is there any sort of common things you'd be like, yeah, that's probably a good place to start, aside from lockup?
Yeah, I mean, lockup is definitely one of my favorites. Every firm is slightly different. Every firm is slightly different. And amongst my different clients, we do track slightly different numbers. But lockup will almost always be on there. Another one that I like is gross margin as a percentage. So this is the idea of, all my legal fees minus the costs of actually delivering the legal work. So realistically, that's a bunch of wages of a bunch of solicitors, in effect. Take one from t'other and turn it into a percentage. The reason that I like that one is it's quite easy in the legal world to get very excited about billing. We do a lot of, oh, he or she is a good biller, or we had a record billing month this month. And that's fine. But if the associated cost of delivering those bills has also gone up, then have we necessarily achieved, well, possibly anything, but certainly not very much? Or to put this another way, if you want billing to go up, go and hire another lawyer. He or she will do more billing. Billing will go up. But if he or she is 50, 60, 70, 80,000 pounds worth of person, well, the associated cost of doing that work has also gone up, hasn't it? And unless we're tracking the sort of both sides of that equation, the fact that billing has gone up this month never terribly much excites me. So I do like gross margin as a percentage. I do like two or three others, but I also just think it's important to have two or three of these things, to track them, to understand them, to measure them over time. There's a very famous business school case study of Southwest Airlines, which is a budget airline in the south of the United States. It's a bit like Ryanair or EasyJet. And because it's America and they catch planes like buses, right? These planes just bounce between cities. And the same plane goes backwards and forwards a dozen times a day, something like that. They are a multi-billion-dollar organization, hundreds of planes, tens of thousands of staff. One number gets reported to their board every single morning. One number. Billions of pounds, thousands of flights, tens of thousands of passengers. One number gets reported to their board every morning. The number, for the record, is the amount of planes that sat on the tarmac for longer than 1 hour yesterday. Because that's fundamental to their business model, right? The planes are just going boing, 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 boing. They land, they spit out some passengers, new passengers get on, repeat. So if there's a plane parked on the tarmac for longer than 1 hour, something has gone wrong. I mean, probably the plane's broken down, or it took longer to clean. There's always going to be a reason, right? But I love this story because they're a multi-billion-dollar organization and they've got to the point where they only need to track one number. But it does get reported to the board every single morning. And if you're the CEO, I guess, of Southwest Airlines, you spend that more, between 9 a.m. and 10 a.m., your first job is to open that email and go, right, flight number 1, 2, 3, 4, 5, 6. What happened? How do we fix it? How do we make sure it doesn't happen tomorrow? And that's what it is to be a really resilient firm, to really understand your data. You don't need necessarily thousands and thousands and thousands of pages of information. You need the one thing that really, really needs your attention that day so that it doesn't happen tomorrow.
Absolutely. That's the airline's equivalent of lockup, I think, there. What are they losing money on and not being able to bill, to ship correctly? Yeah, it's a great shout, because then it really directs your attention and it makes sure it makes sure that you're putting your attention in the right place to make the biggest impact in your firm. We've mentioned lockup a lot, and that will reappear later in the conversation as we go through the findings. So the report is the 2025 Law Society Financial Benchmarking Report. 145 law firms took part in this year's survey across England and Wales, and majority of those firms had a turnover of greater than 5 million. So just as a sort of start point of where we're at with the benchmark. So 71% of firms reported year-on-year growth in 2024. With a third stay in, there was growth over 10%. So put to you, Tom, is that what you would have expected? And does that mean everyone's got their financial strategies correct and we're all good to go?
Yeah, we're done. Thank you very
Yeah,
much for tuning in.
easy.
I mean, it's worth saying, isn't it? Inflation in the period that the survey runs for was, I think, about 3 or 4%. So anything less than 3 or 4% means you haven't even beaten the bank, if you see what I mean. And as you say, I think the report comes back at 10%. And it's a great report, by the way. The Law Society, Hazelwood's, Lloyds Bank, they've done it every year now for, like, I don't know, a dozen or so years. It's a great read. Make sure, not just read this one, read the last few years again, because picking up a trend is important. So would I expect that? I mean, I suppose yes, but I would caveat it and say 3 to 4% is just the inflationary rise, assuming that your prices have tracked in line with everything else. But the other thing is, I think you'll see in the report that much of that increase in profits was off the back of client interest. And so if you start to strip that away, underlying profits, I think, are closer to sort of 1 or 2%. And actually, then you might argue that sort of most law firms aren't beating the bank. They aren't staying in line with inflation if you remove client interest. And why should we remove client interest? Well, for two reasons. One is interest rates go up and down. You just cannot rely upon it. It will change. But two, come back to that SRA consultation. That is one of the things they consulted on. So will they change that? Don't know. My crystal ball is on the blink, but it's quite plausible that they might. They've certainly got that particular bee in their bonnet, haven't they?
Yeah, absolutely. And I guess if that is something that you're relying on, I think that report is very eye-opening to make sure that it isn't something you're relying on. I guess it also shows, and it's quite comforting, that you're not the only one. There's several law firms also relying on that, and probably good reason to review. And I guess so, in the Lexis Bellwether report that also came out, I think it was late last year, 63% of SME firms were looking to organically grow over the next 5 years. So what strategies for financial growth would you recommend law firms consider? So to help overcome the interest, to help with their goal of growing over the next 5 years, what strategies would you consider or recommend?
Yeah, and I think there's two sides to this coin, and let's do the organic growth first, because you're right, I think that was what that Bellwether report talked about. And a minute ago, slightly flippantly, I said, oh, you want to increase billing? Just hire another lawyer, right? Ta-da. Easy. But do you increase profits when you do that? I mean, that's a much harder question, perhaps, isn't it? Now, there's an old wives' tale in the legal sector that every fee earner should bill roughly 3 times their own salary. This is sort of this old wives' tale is a third, a third, a third. So a third goes to their salary, a third goes to their associated overheads, and the final third is the sort of profits of the firm. Those same surveys that you've just mentioned, Amy, I mean, they have very forensically and very statistically shown that wives' tale is completely wrong. But it is a useful wives' tale, and it's a great rule of thumb. So how do you grow organically? Well, you bring in a person, fine. You make sure that they have the ability and an inclination and opportunity to bill at least 3 times what their salary is. And so how do you grow organically? Well, it's not just about bringing in that person, is it? It's about making sure that he or she has the right tools around them, that he or she has the right admin support around them, that he or she's technology supports them correctly. Because if that person is going to achieve 3 times their salary, they need all of that sort of infrastructure around them, which means that they can be really efficient, which means that they can achieve that. The rule of thumb, of course, is also really useful because it doesn't necessarily follow that he or she is a solicitor. It's 3 times their wage. Yeah. So if you're looking at a fully qualified solicitor who is 50, 60, 70 grand a year, that individual needs to be billing something in the rounds of £200,000 a year if you're following this little rule of thumb. And again, statistically, rule of thumb not valid, but we'll carry on with it for now. But equally, for the same amount of money, £50,000 worth of solicitor, I could probably get 2 paralegals on 25 grand each, and they maybe only need to bill 75 grand each to apply my same rule of thumb. So it is about how you sort of create your pyramid of people, how you build some of those efficiencies within your team. I think growing organically is not necessarily about, well, if I just pop an extra person in the top, he or she just magically will bill £200,000. I mean, maybe they will, great. But what infrastructure around that person allows them, gives them the ability and the opportunity to bill that £200,000? And I think so many firms don't focus on that bit and just go, well, another bum on another seat will earn me £200,000. And it just, the equation isn't quite as simple as that.
Yeah, and I guess talking about the additional tools and resources and that foundations, I mean, they of course require investment. They of course require, money to be spent to get them in place. But actually, once the effort typically has been put in and the foundations are laid, that scalability is just next level. You're earning 3, 4, 5 times the amount you invested continually as you grow. So I guess, yeah, making sure you've got the tools in place can mitigate some of that additional growth that you might need. I mean, let's not spend our time talking about AI, but you might not have to hire legal assistants or admin staff if you have the right tech tools that can essentially do that with a little bit of additional human effort. So I guess from an organically growth point of view, that can definitely help and resource that plan.
Yeah, I completely agree. And I think, unfortunately, so many firms either don't have some of those tools at all, and so are clearly missing a trick, and clearly, or have some of those tools but are just not using them to the advantage that they can give. And so I think that's where we're growing. This topic is growing organically, right? Part of me is tempted to say you grow organically not by dropping in an extra person at the top and just assuming that they will magically bill 200 grand a year. What you actually do is take all of your existing people, all of your existing tools, all of the existing things that you've got in the firm, and just find a way to squeeze another couple of percent out of them, right? And without getting into the maths of it, yeah, if all of those expenses are already in the middle of the P&L, they're already there. But if I can raise the number at the top of the P&L by 2, 3, 4% by those sort of little tiny marginal gains, then that 2 or 3 or 4% at the top of the P&L goes 100% to profit because the overheads haven't moved even a penny in this example. I do think that a lot of firms miss quite a lot of tricks around being as efficient as they can be with what they've already got.
I think there's a great quote, and of course I can't remember it and I'm going to butcher it, but I know it is mentioned and referenced in the Atomic Habits book by James Clear, and it's about people when they're trying to grow or change or improve, they typically try to add, but actually sometimes taking away. So taking away efficiencies, taking away costs that you don't even know you're paying for, taking away things can actually help you grow quicker, more efficiently, in a more scalable way than actually trying to add in at the top.
Yeah, I think you're exactly right. And so said the growing pains of every professional service firm in the country, right? And there's always this. I'm doing a lot with my hands, aren't I? But there's a little step graph, kind of as we get more and more and more work, we need more and more people, right? Obviously, of course we do. Ultimately, we sell our time, and there needs to be that much time available to us. But every professional service firm in the country, accountants, lawyers, etc., big firms, small firms, city firms, countryside firms, will always have that question that you've just asked, Amy, because they will always have that moment of, have I got more work than staff, or have I got more staff than work? And you will never get it right. You will always be slightly overworking the people or slightly underworking the people. And this sort of step graph of, right, I hire and then that person gets full with work. And so then I hire again, but then that person gets full and then I hire again. It is the perennial challenge. So given that that is always going to be there and you're always going to have that thought process, why not also think about the efficiency so that when you hire that next person, they can hit the ground running, that they can be that little bit more efficient. Or maybe you do still need to hire that person, but you can squeeze 2, 3, 4 months worth of efficiency out of the existing people. I think there's lots of tricks, perhaps, that many firms miss. I say this, I've just recently hired somebody for my firm, and I've made all the same mistakes that I'm just discussing with you. But that boils down to my to-do list was just getting ginormous and it was ridiculous. And so I've hired somebody for no extra work, no extra clients. It's just the fact that I was running around with my hair on fire. So you will never get it quite right. But I do think there's something in just reviewing whether just another person on another bum on another seat, is that really the right answer?
Yeah, and I think that goes back to your data and tracking point, that it's important to know what matters to you and what your ultimate goals are and how that ties in with the numbers. There's of course the marketing and BD element of this conversation to grow organically. That's not what we're going to discuss today. I've got plenty of podcast episodes that you can cover for that. But of course that plays a part as well. When you have hired that person and you do need an extra bum on a seat, how effectively are you then managing your BD efforts and your marketing to bring those leads and that work straight in? So as part of the report, a pretty startling figure was that fee earner break-even point that we're discussing, the profitability of fee earners, has risen due to overhead costs. I mean, that's not surprising to anybody. But the overall theme in the report was a decline in productivity. So the average chargeable hour for fee earners was only 773 hours. So what should law firm leaders be focusing on to switch that stat up and to be increasing profitability? I guess we've touched a lot on it there already, but anything else to add from a profitability point of view?
I mean, it's an incredible statistic, isn't it? I know, I like numbers, right? So I'm just going to geek out on that number for just 1 minute.
Go for it.
I appreciate that other people, anybody else listening to this podcast, if you want to, go and make a cup of tea now, that's fine. But my thing is 770 something hours. It's nuts, isn't it? Just bear with me for a second. 7.5 hours in a working day, 5 working days in a working week, about 46 working weeks in a year by the time you've had some holidays. Yeah. I promise you, I've done this maths. It's about 1,600 working hours in a year.
Wow.
So 770 odd isn't even half of their time. Not even half of their time. But we sell time. And we're not even selling half of it. Apply that to a retailer. Yeah, I mean, I was going to sell those half of those Mars bars, but I thought I couldn't be bothered. What? I'm just going to throw those Mars bars away. Don't want those Mars bars. What? It just wouldn't happen. Just wouldn't happen, would it? Now, in saying all this, of course, I'm well, 2 points. One is I can already hear somebody shouting at the screen going, well, I work on fixed fees. And that's great. And I love a good fixed fee. I'm not getting anything against fixed fees. You are still selling your time. You're just packaging it differently. So let me just get that out there. But the other thing is those 770 odd hours that are in the report. Obviously, you've got an amount of training time. Obviously, you've got an amount of business development time. You've got team meetings. You've got the moment that the paper in the photocopier jammed and it took you half an hour to unjam it. I'm not dismissing all those things. I'm just saying that collectively added together, they add up to more than the time we are actually selling, which is, the thing that we sell. And that can't be right, can it? Cannot be right.
Feels off. Feels very off.
It feels very off. Feels very, very off. So, having geeked out on that number for a little bit, your question was, what do we do about it? I think, first of all, it is really important. And as much as I made a joke about it, it is really important to acknowledge that, CPD is important. Team meetings and sort of culture and cohesion are important. Business development is important. So make sure you're sort of understanding those numbers and you're adding them in. So if we've got 700 and whatever of actual chargeable hours, by all means, something, well, actually, in a year, maybe there's 100 hours of CPD. Maybe there's a couple of 100 hours of business development and networking. Fine, but I'm still only in the rounds of 1,000, maybe 1,100, aren't I? And I said a minute ago, there's about 1,600 working hours in a year. So we've still got 500 hours, weeks and weeks and weeks of time that ultimately doesn't get charged to a client. So there's plenty of room for maneuver here. But I guess what I'm saying is make sure you do add in those other very important non-chargeable activities because they are important. It's just even allowing for them, there is still a problem. What's the problem is your question. I mean, that's a whole podcast in its own right. But it boils down to a mixture of either the inefficiency that we discussed, so much time that just is going on a clock. So much time that isn't sort of contributing to the matter and just isn't billable. But then I think some of it is also kind of a slight reticence. I speak to a lot of fee earners who kind of do what is sometimes referred to as moral editing, where they sort of go, oh, couldn't possibly charge the client for that. I couldn't possibly charge. I'll just take it off my timesheet now. I know it's not billable. I know it's not chargeable. I know I faffed around. I know that should have taken me 1 hour, but it kind of took me 2 because I got distracted. So I'll only put down the first one. And just, I get why people do it. The people are trying to be nice, basically. But just stop right now. There is a really important distinction that people need to have in their heads between matter-related time versus billable time. And they are two completely different things. And what you're putting on your timesheet is matter-related time. So maybe in your head it should have taken 1 hour, but for whatever reason it took you 2. Put down the 2. It might also be that your finance team knocks one of those off, and that's completely valid as well, perhaps. But the billing of that is and should be a completely separate thought process. And my point here becomes, if you're putting down 2 hours, even though in your head it should have taken 1, maybe it is taking everybody else 2. Maybe you think it should take 1 because that's what other people around you are putting down on their timesheets, but they are also morally editing those timesheets as well. And so then we're into, actually, it's always taken 2 hours. And we've never had the data before, and it's always taken us 2 hours. But it should be taking us 1, in which case, what's wrong in our process? Where have we got our template wrong? Why have we got the workflow in the system set up the crazy way round? It's all that kind of stuff where a lot of this is sort of saying to the fee earners, if you have put down 2 and it should have been 1, that is my fault as the managing partner of the firm, because that means I have got something wrong in our processes, in our templates, in our workflows, etc., etc., etc. Thank you for bringing this to my attention. Let's now work together to get it down so that it does take you 1 hour. But until it takes you 1 hour, please put down 2 because that's how long it took you.
Yeah, I mean, it goes back to the data and tracking point again, isn't it? We can't make the improvements we need to make if we don't know the real challenge that we're up against. And you're right. I think not only does that give visibility to whoever needs to deal with those operation and process efficiencies, but it also empowers the fee earners. Like, your time is valuable, and we need to make sure we're maximizing that and giving you the best chance to hit these targets. So don't do yourself a disservice, and whether that be actually don't do yourself a disservice to charge the client because this is chargeable, or for the other reason that actually the efficiencies need to be made so you're not wasting your time doing menial tasks. Either one, brilliant. It's I think reframing that to thank you for bringing that to my attention is a great sort of cultural shift for the teams to better the firm and to better the teams and the fee earner for sure. Moving on to total year-end lockup days, as we mentioned previously. So that's WIP and debtors combined. So this increased from 143 days to 146. So not a huge increase, but still a huge amount of days. And our previous podcast guest, Simon McCrum, who I can hear him screaming across all of these stats from the report, he provided a really great commentary on LinkedIn, so that's worth checking out. But he highlighted that those lockup days, 146 days, are 5 months and 5 massive paydays, to quote him exactly, that have to be funded by the firm. So what are your recommendations for improving that cash flow? We've talked a lot about profitability, but getting that cash moving through the firm, what are your recommendations?
Yeah, I mean, yeah, I like Simon a lot. We've worked together several times, and yeah, he does like that example, doesn't he? Is whilst that matter is sat somewhere in the system, the firm isn't getting paid, but you know who is getting paid? The fee earner, because they're going to collect however many months worth of salary. Yeah. Um, I think again, arguably, like if I'm a clinical negligence firm, if my lockup really was 140 something days, I would be ecstatically happy. That would be amazing. You know, most clinical negligence firms measure it in years, not in days. Um, so some of it is actually just knowing what's normal for you and perhaps what's normal for that team as opposed to this team and tracking it a little bit over time and knowing where your particular ebbs and flows are. But the rest of it is just what I call sort of good matter management, almost all of which is actually right at the very start in the sort of very initial engagement. So, you know, what have we said about billing on account with the client? What does it say in our client care letter about milestone payments? What's going to happen if the client does, for whatever reason, stop paying our invoices? And how are we going to down tools in a compliant manner? Because, for example, we might need to come off the court record. So are we going to get them to sign that waiver, whose name escapes me, so that we can come off the court record and put it and do that on day one and put it on our file? So that then on day 140, whatever, when they've not paid our invoice, we can just pull it out of our file and say, terribly sorry, you've stopped paying us. Here's the court record. We've come off the court record. We used the waiver that you signed 5 months ago. So a lot of not causing a blockage on day 140, whatever, is actually what you do on day sort of -1 when you're busy setting up the file and you're agreeing whatever scope and whatever terms and the client care letter and the payment on account. It basically pretty much always goes wrong there. It's just you don't notice for another 140 something days.
Yeah, it's a great shout. And I guess that makes me think, how should your finance team or fractional CFO or whoever is managing that, how should they be involved in your operations or in your tech selection? Like, how much say and influence should they have? I'm assuming it's a good idea for them to be involved.
I mean, I would obviously
Yeah.
say that, wouldn't I? Yes, involve your finance team. Um, but you know what? I think actually involving your finance team can sometimes help because the fee earner doesn't want to necessarily lose that relationship with the client.
Mm-hmm.
You know, they will be working with him or her for some amount of time. So depending on the client, it could be a client that sort of sends repeat business. There could be a sort of overarching relationship here. So sometimes having that kind of the big bad FD says that I need 2 grand on account. I'm really sorry. It's definitely Tom's fault. He's a bit of an arse. Fine, blame me. That's absolutely fine, and actually is something of a tactic, and it does kind of work or can work. And I think in involving anybody else, which I might argue ideally is your finance team, but even just the solicitor sat next to you. In involving anybody else, you get a little bit more confidence in what you're doing. And so when you're sort of scoping that initial engagement, and you just send it across the partition in your open plan office to the person next to you, and just kind of go, would you charge 2 grand for this or 2.5? And how much payment on account should I take? And have I thought about the disbursements? Have I got the right disbursements? And will I need all of those in advance? And what about council's fees? And what? Um, 5 minutes spent discussing it with anybody, but yes, potentially your finance director, just makes you think about some of these things more. And just again, what you do in those first couple of days sets the tone for the rest of it. The very first time that client doesn't pay their invoice sets the tone for every other time you send them an invoice.
Yeah, absolutely. I think the combination between teamwork and peer review and getting that help, not going alone, coupled with really clear, strong, data-driven processes that are backed by mistakes we've made, improvements we want to make, the values we hold, I think is a winning combo for, like you said, making sure that the first time they miss their invoice sets the tone, and from the first interaction, how we work together is super clear. I think that's really helpful for client service and for the employees. There are so many stats in the report and not enough time to run through them, but is there anything you feel is missing from the report that firms should actually be focusing on or should be considering, or a stat in there that wasn't recorded? Anything you feel is missing?
I think it's a great report. I say I've been an avid reader of it for years and years and years. So I think it's a great report. If you haven't read it, go and read it. But so I wouldn't necessarily say there's anything missing. What I would say is something that I say to all my clients, which is we can track these various numbers. We can track profitability. We can track lockup. We can track these various things. In doing that, you want to be very careful that you're not only tracking metrics that are backwards looking. So you need something, and again, probably only one or two. My whole thing here is to not overcomplicate it. But you need something that's also a little bit forward looking. So how many matters did I open today, which will work their way through their system? A matter that I opened today is an invoice 6 weeks from now, and it's cash 3 or 4 weeks from now. So if I've opened it today, it's cash 10 weeks from now. So knowing that is helpful because it helps me project forward. Where's my business development pipeline, and how many proposals are out there in the ether, and how many client care letters are out there in the ether? I've sent them out, but they've not been returned. And so that gets me a feel again for roughly what's my throughput and roughly where might I expect to be next month or the month after or the month after. And that gives you an opportunity to sort of be a little bit more forward looking and a little bit more proactive rather than reactive. Any accountant worth their salt is going to tell you that you should do a 13-week rolling cash flow. That's what the textbook says, which is a cash flow forecast that projects forward 13 weeks. One of the reasons that accountants get quite excited about that is 13 weeks is considered to be a little bit of a sweet spot, in that as you project further forward than that, you're into kind of educated guessing territory. And there's nothing wrong with educated guessing, but it is ultimately guessing. Whereas if you go a bit too close than that, so I'm projecting next week, and you're probably going to do that very, very accurately, but it's too close. If there's a problem, if something isn't quite right, it's 7 days from now. There is almost nothing you can do to fix that. So a 13-week rolling cash flow is a very, very useful tool. A lot of accountants live and die by them. This accountant certainly does. But the reason is it is quite a nice sweet spot of, if I'm constantly doing a rolling forecast and I'm constantly 13 weeks ahead of myself, and it shows me that there's a problem in week 10, well, that's nearly 3 months from now. Surely there's something I can do between today and when that turns into an actual reality. 3 months, you'd like to think that there's a lever that I could pull that would change something. So, to your question, Amy, the report's brilliant. Everybody should read it. But in applying it to your own firm, think also about forward-looking metrics as much as rearward-looking ones.
Yeah, great shout. I think that's a good setup for innovation, for experimentation. I think forward thinking looks to give you different opportunities, gives you freedom to think about, what's coming. So yeah, I think it frees a lot of people up and provides maybe confidence or just, something that allows that innovation that we need to really push the boat out and help with that organic growth. A recent podcast guest, Kate Burr, owner of Hive Risk, shared that you work with her as her financial director, so she won't mind me saying here in this conversation. She shared that you help her steer through storms and ensure that they can achieve their really big goals and visions they've got of Hive Risk. I know they've grown dramatically over the last few years. Check in that podcast to find out Kate's full story. But I guess that helps. The point of your relationship there is to help her be resilient, is to help her meet her goals, look forward, what we were saying there. So what does it really mean to be a financially resilient law firm? I'm guessing that plays a part to help you steer potential challenges, but is there anything else that makes you financially resilient?
Well, I mean, Kate's amazing. She's like my get my teeth back in. She's my entrepreneurial hero because you're right. The growth in that firm is nuts. Really, really impressive. I wish I could lay any kind of claim or credit for it. I'll claim my 1% of credit and she can have the other 99, I think. So yeah, they are great. Many of my other clients are great. I think financial resilience is like the easy answer I could give you is that you've got a couple of tens of thousands sat in some bank account somewhere that's sat there for the rainy day. Yeah. And that's your weather the storm metaphor, and that's not invalid. And by all means, have a little bit of kind of money up your sleeve somewhere. Nothing wrong with that. But there is such a thing as too much. You can squirrel away all this money, and what are you actually going to use it for? Actually, that isn't being resilient at that stage. That's just being a little bit daft. Like, why have you got all these pots of money? I think the truly resilient firms are the ones that know what they can spend and when they can spend it and know actually because of whatever forecasts and because of whatever budgets, actually, I can afford to spend this now. And if in spending it now, I will get a return on that investment and it is worth it. And I have thought about it. So the truly resilient firms aren't just, I've got some money squirreled away for a rainy day. It's the firms that are kind of really actively making some of those decisions. And, you do have to spend money to make money. You just do. You do have to make some of these investment decisions, and you do have to sort of put your money where your mouth is sometimes. And you know what? You won't get all of them right, but it would be nice to get the vast majority of them right, wouldn't it? And I think for so many of my clients, and Kate's a great example of this, her sort of entrepreneurial spirit is that her gut's answer is usually right. Like 9 times out of 10, her gut is completely accurate because she's just good at what she does. But I like to think that for her and for others, having me kind of crunch a number and kind of go, yeah, yeah, your gut is telling you to do something, but the maths would support your hunch, basically. I think that helps. I think that's where you get true resilience from, and you've got the ability to really um, take opportunities as much as just save for a rainy day. Um, and it also means, by the way, that the one time out of 10, the one time where we've crunched this number and whatever your gut's telling you, you've obviously eaten something funny for dinner because it just isn't quite right. Again, truly resilient firms have the ability to have that debate. And whatever it is that board of directors or those 2 or 3 heads of department or whomever it is have a forum where they can actually sit around the table and really have that debate and really decide if they're going to do it. Again, grounded perhaps in data, but also using their gut. And, many firms that I've seen over the years, I don't have that level of resilience because they either have one managing partner whose word is law. Not sure that's valid. Or they have some all partners meeting where there's 15 people in a room, half of whom haven't read the board minutes, the other half of whom are staring out the window and kind of, the People's Committee for the Better Purchase of Paper Clips never quite makes a decision. So that was a really long-winded answer to your question. But I think what I'm trying to say is resilience is having a little bit of money in the bank, but it's also about having, knowing what opportunities you can take and when to take them, and having some level of robustness to your decision-making process that isn't quite sticking a finger in the air, but also isn't, we need 17 meetings and 19 different board packs, and it's going to take us 3 years to make this decision. There is a happy medium, I think, between all of those extremes.
Yeah, it's easier said than done, isn't it, really? And I think going back to Kate's amazing journey is what's led her to be 9 out of 10 times successful in her gut feelings is the fact that she's experimented a lot and she's probably failed a lot, which means she's learned a lot, which means now when she makes decisions and she's steered, her gut feeling is correct, and thankfully backed by the data, backed by probably a lot of tracking and a lot of metrics and all of those experiments being recorded and tracked to again back up those feelings and thoughts. But that's difficult. That's a difficult thing to start, because if you don't have that track record, experimenting can and failing can feel like a failure, can feel like a bad choice, and can stop you from experimenting further. Apart from a bit of money in the bank, apart from getting your data sorted, is there anything else that firms should have in place to help weather those storms, build a bit of resilience, and help with those decisions and that sort of data tracking? Is there anything firms can do today to improve that?
Yeah, I've waffled a lot on this topic, so let me give you a really simple answer. Get a 13-week cash flow. Get one.
Nice. Yeah.
And look at the number that it spits out in week 12. And if that isn't the number that you want, you've got 12 weeks. Go and fix it.
Love that. Simple. And to be honest, I want to finish on going back to basics and being super simple, to be honest. So whether firms have a full-time finance director, a huge finance team, or an outsourced CFO, whatever they've got in place, what questions should leaders be asking of their FD, of their CFO?
Well, ask him or her, what did we do last month? What will we do in 13 weeks from now? And where will we be a year from now? Three very simple, well, in fact, the same question, but with three different time frames placed on it. And he or she should be able to, he or she should be able to answer that question, right? They will have some number they can point to, but listen to the story that they tell you as part of that. Which numbers have they spoken? Have they spoken about profit? Have they spoken about cash? Have they spoken about revenue? Listen to the story that they're telling you, particularly for the future-looking ones. Listen to the variables that they list. Listen to the risks that they describe, the nuances as to how they know that they will or won't be able to achieve those numbers. Because hopefully you've got a great finance team, in which case they should be able to not just factually, they will be able to factually give you a number that answers those three questions. But really, it's about the story they tell with it, how they explain it to you, how they help you understand what would stop that from happening. Because that's what you need as a business owner, really, isn't so much 13 weeks from now, the bank balance will be X pounds. And as fascinating as that is, really, it's about it will be X pounds, assuming A, B, C, D thing happens. And then you as the business owner can go, well, actually, I'm quite worried about B thing. I think B thing could actually be a problem. Let's spend the next 13 weeks making sure that it isn't a problem.
Yeah, absolutely. I think just to also add in the point we mentioned about operations and client service is the questions you should be asking is what impact could our onboarding, inquiry, quoting decisions make on our ultimate outcome when they become a customer and perhaps things go a bit awry. I think that was a great insight into what actually the impact day one can have on day 146. So I would also ask questions about efficiencies and processes of your FD, because I'm sure they will have more than enough suggestions to make sure that cash flow and profitability is there.
Yes, yeah, I'm sure. I'm sure they will, and I think, you know, it is too easy to assume that your finance function are bean counters, right? That they are looking at retrospective figures, that the client account reconciliation is required for last month. And it is required, and there's a rule, so please do it. But it's backwards looking. And so, as important as it is, and please make sure you've got them because the SRA will get very angry with you if you didn't. Um, Good finance functions are looking forward. They are looking more strategically. They are attempting to forecast. And sort of the joy of that is the forecast is going to be wrong. The forecast is going to be, in some cases, massively wrong. I've been doing it 20 years, not got it right once, not even once. But in going through the process of that, in thinking about the variables, in thinking about, well, what happens if this goes up? What happens if this goes down? All of that is planning. All of that is thinking through. And so the exercise is really, really valuable. The number that it spits out, sort of valuable, sort of, a little bit, but it's more about the process.
Absolutely. And I think that's a perfect way to end this conversation. Thank you so much, Tom, for your time and expertise today. It's been really great to chat. Like I said, there are several other episodes about marketing, business development, Simon McCrum, Kate Burt, that you can tune in also to find out more about those stories. But thank you so much, Tom, today. Really appreciate it.
Thank you.